All right, for this video, I wanted to talk about active versus passive interests in a business, and specifically the passive activity loss limitation rules. So if you're an owner in a pass-through entity, so it's an S corp or a partnership, you need to be very careful about categorizing your participation in the business, because if the company is generating losses, that is going to drive whether or not you can deduct those losses on your federal tax return. Okay, so if we start with some of the basics here, in Section 469 defines a passive activity as any trade or business activity in which a taxpayer does not materially participate in the business. Okay, so PAL, or passive activity losses, are losses generated from those passive activities. Now, when a taxpayer reports a loss from passive activities on their Form 1040, those losses can offset other types of passive income, but you are not allowed to offset active income with those losses. So I think the best way to illustrate this is look at an example, and then we'll talk about it a little bit more. Here we have John. He's an individual taxpayer, and he holds a 20% limited partner interest in an LLC. The LLC is engaged in the business of operating several restaurants, right? So it's an active business. John holds his 20% interest as an equity owner, but he does not participate in any of the day-to-day or managerial decisions of the business. So when John came in as an investor, it was really just a silent equity partner, right? A limited partner just putting capital into the business. The other 80% ownership by the other individuals, they're the ones doing all the work. Okay, so if the LLC partnership generates $100,000 of net loss for the year, John's going to be allocated 20%, $20,000. That's going to be on his Schedule K1, line 1, right? And then on John's Form 1040, let's say he reports W-2 wages from his full-time job of $100,000, right? So the W-2 wages are active income to John. So when John looks at this, he thinks, okay, well, this is great. I have $20,000 in losses. I can just deduct that. The loss passes through. It offsets my $100K in W-2 wages. So now I have taxable income of $80,000, which means I have a lower tax bill. That is not how this works. Even if John has basis in the entity, right? So if he has sufficient capital in there where he has some tax basis and could deduct the losses anyway, he has to be mindful of the passive activity loss rules, which are going to apply here. John's investment in the LLC is a passive activity, which means it's subject to these PAL limitations. So John cannot use the losses to offset his wages, but the losses aren't gone forever. Right, so IRS Form 8582, this is included with Form 1040s. It's a passive activity loss worksheet. And on the 8582, he would record that he received $20,000 in current year losses from a passive activity, and then those losses are rolled forward to future tax years and can be used to offset future income from the same passive activity streams. Okay, so if we go back up to this example really quick, just to highlight another kind of, if we change the fact pattern a little bit, let's say it's still a passive activity to John, but John's also invested in another passive activity that generates income. So let's say he's got this 20% interest as an owner in the restaurant business, and then he also holds an interest in another pass-through LLC that's profitable. So let's say the other LLC runs, let's say a golf course, right? So he's an investor in a golf course. It's still a passive activity to him, but it's profitable. If he has profits from that other passive activity, he can offset the $20,000 in losses with those other passive activity gains, right? So he can net the two, but they have to be in that same bucket. They have to be passive activities. So again, he can't use these losses to offset active income. So he can't offset W-2 wages. He can't offset portfolio income like capital gains, dividends, interests. Those are not passive income streams, right, for purposes of these PAL rules. So again, it's important to really, really assess carefully what is your activity in each passive investment you have, because you need to adequately characterize it as either active or passive. Now, so if this is a passive activity, what would John have to do to make it active? Well, in order to make the activity active rather than passive, he has to materially participate in the business operations. So what is material participation? In Treasury Reg 469-5 Cap TA, we have a 7-factor test, right, for material participation. And these are the 7 tests. Now, I've highlighted the first one here because this is the one that, quite frankly, comes up the most. If you want to materially participate in a business, this is going to be it, in my experience. Obviously, you have all the 6 options in here, and we'll talk about each. But for the most part, I see it in this item number 1, right? The taxpayer spent 500 hours or more during the year actively running the business. Okay, so the second one, let's just go on down the list here. The individual's participation is substantially all the participation in the activity, including individuals who are not owners. This is the second most common, right? So if you have an individual, let's say they're not at 500 hours. Let's say they only spent 30 hours a year working on the business. If they're the only one that's doing any work, so let's say I set up a consulting business, I'm the owner, I do everything, I make the calls, I talk to the clients, I do the billing, there's no other employee. Even though it's only 30 hours of work a year, I materially participate in the business because I'm the only person doing anything. And so in that case, this would be an active trader business for me, or not an active trader, it's an active trader business, but it's active with respect to my participation in the company. The third option, you fall somewhere in the middle here. You have between 100 and 500 hours spent on the activity, but not less than anyone else in the organization. So similar kind of issue, right? You're between 100 and 500 hours spent during the year, and there are other people that work with you. Let's say other owners or other employees, but you spend more time working on the business than they do. If that's the case, then it's active business to you, right? You still get that active participation element. The fourth one, significant participation activity. The fifth one, this is the look back. The individual materially participate in the activity for any 5 of the last 10 years, right? So it's kind of like a rolling test. If you had any 5 of the last 10, you could still get it. Option number 6, the activity is a personal service activity, and the individual materially participated for any 3 tax years preceding the current year. Personal service activities are companies where you're performing personal service contracts. So things like lawyers, doctors, dentists, engineers. You're not selling like an inventoriable product. You're selling a service that's performed by you as the individual. And then the last one is just an overall facts and circumstances test. So it's kind of a catch-all where you kind of look at your activity, the business itself, and you can kind of gauge whether or not you materially participate in the business and you're an active business owner. Okay, so a lot of options there. Again, I mean, ideally, you want to hit one of these less subjective kind of tests, right? If you can demonstrate you spent more than 500 hours during the year working there, perfect, right? That's the slam dunk. You have 500 hours of active participation, so you're done. You're an active business owner, and you don't have to worry about these passive activity loss limitations on your tax returns. So that covers it. A lot of material there. Hopefully it was clear and it was helpful. If you have any questions, please leave me a comment below. Happy to answer, and I can. And I look forward to seeing you again on the next video. Thank you.